In this video, traders, we're going to look at the double stochastic strategy. Stay tuned. Hey traders, a very warm welcome to you. If you're a subscriber, thank you for your support, much appreciated. If you're new here, welcome too. Okay, so this is the double stochastic strategy. It's used on a Forex chart. We're looking at a 1 hour chart. It's a day trading type of strategy, or a day trader's entry, putting it into a swing trade. Like I say, Forex major pairs would probably be the favorite ones for this. You could probably get away with it in indices and probably get away with it also on some of the thicker commodities like your gold, your silvers, crude oil, maybe natty gas, although I can't say I've looked at it on natty gas. Some of your high, thick stocks like your Apples, your Netflix, your Teslas, your Tesco's, your Vodafones, you know the score. Okay, so, but really major FX is where we want to be looking at it. Okay, so I've got in front of you now AUD USD on a 1 hour candlestick chart. I have two stochastics on the screen. I also have a moving average. The moving average is a 20 period exponential moving average. The stochastics are, if I can click them, I'll tell you exactly what the settings are, gents and ladies. Percentage K 21, percentage D set at 4, smooth at 10. Smooth might be called slowing or whatever it is on your chart, but you get the idea. You've normally got 3 parameters with the stochastics. The important thing is to have percentage K at 21, percentage D at 4, and whatever the third parameter name is on 10. The second stochastic is a little bit quicker. We've got percentage K at 5, percentage D at 2, and smoothing at 2 as well. And you can see here visually what we've got. We've basically got a slower stochastic and a faster stochastic. Now, I like this kind of trade because it gives you, you're not relying on loads of different indicators, which can work under certain conditions but can get a little bit cluttered, a little bit crowded. You've got one, but you're just using different settings for it. You're basically saying, okay, I like this indicator, I want to use it to its maximum ability. Let me adjust the settings but use the same inputs but control the outputs. So what you've got is a slow stochastic, which is on the top here, which is going to give you a broader overbought, oversold condition. It's going to go with the kind of ebbs and flows of the major moves on your 1 hour chart, right? It's going to not be so noisy. It's going to give you the main kind of trending positions of your 1 hour chart. The faster stochastic on the lower window here is going to be much more sensitive. So it's going to be triggered overbought and oversold by the little pullbacks within the broader trend moves. And that's exactly what we're looking for, guys. We are looking for broader trend moves identified by the slow stochastic on the upper window here. And we want those smaller pullbacks that allow us to get on these moves on the lower window here on the fast stochastic. Example here with AUD USD, decent move off the lows, indicated by a oversold to overbought condition on our slow stochastic. Pull back, this is where the 20 period EMA comes in, pulls back to 20 period EMA. We're still in an overbought condition on our slow. Our fast has now gone into oversold. Bang, it's exactly what we want. In a perfect world, okay, I'm going to be critical of this, and I like to not cherry pick too much. I would be a little bit concerned the fact we're in a range here, but if that wasn't the case and we were in fresh territory up here, it would tick every single box possible. But it's still good because we come from low on the prior day to high. We had a good trending day. We've had a rejection of the down move on this prior day. On the day before, yesterday, whenever we were trading it, we've had signals that the bulls are more in control. So I like it anyway, but I would be a bit cautious of that. Nevertheless, we've gone from oversold to overbought. We're in overbought condition. Let's get the pen back out here. We're in our overbought condition here. We're in our oversold condition here on our fast, which I say got the bigger trend, which is the slower one. Our slower retracements, which is our quicker one. We're hitting the 20 period EMA. We can't get a better trigger than this. Our risk is quantified. We bounce off the 20 EMA. You can take it on a first green off the 20 EMA. Your stop's going to be below that low. It's so tight. It's perfect. This is why I love stuff like this, because you can take them all day long. Your risk is kind of 10 pips, 15 pips, whatever, 20 pips. Your target is going to be 5 times that, 4, 5, 10 times that if you really want to go crazy with it. I take it where it's going to be. You can either take it out when you start to get first overbought, which is probably a bit early for me, or a retest of highs. That will be my preferred exit for it. If you're going to take the pullback anyway, and you know, if you're subscribed to the channel, guys, you'll probably see that I've talked about this first pullback trade before. This is a little bit of an extra flavor with this. Is on a 60-minute time frame in an hourly chart. This is using the stochastic to give you a little bit more of a filter. So you add more filters, you get less setups, but you get juicier setups when you get them. So that's a nice trade, isn't it? Let's have a look at Euro US dollar. Same kind of thing. This is on the short side this time. A bit of a better trend. We've come off the highs. We've pushed down into sort of oversold condition for quite a long time, which is nice. We get our overbought on our quicker stochastic. Tags that 20 EMA again. You don't get better than this. You don't get better than this. Pushes up. Goes overbought, rolls over. So a couple of entries. Let's talk about the entries. We talked perhaps that you can go on the first close of your candlestick after you tag the 20 EMA. Fine. You can go when your quicker stochastic goes from overbought into oversold condition. I think that's pretty cool as well. That makes a lot of sense. When you come off that overbought condition, take the trade as you break through, whatever the price may be. You might be a little bit late to the party on that, but at least you're waiting for it, and you're not taking it while it's sticking in oversold condition. You're waiting for it to roll out of it, so that's fine as well. And then the stop's going to be above the swing point. Targets on this, like I say, current lows, or you know, run it and maybe when the slower stochastic comes back into the kind of midpoint territory, or as I've done a video on before, which I quite like, is when you break up the stochastic even more. So you kind of take, instead of your 80s and 20s overbought or oversold, you split it and you go, okay, well, I'm going to do, you know, 65 or something as a trigger level to exit. You can break up and fragment the stochastic even further and give you an even kind of more strict rules on where to come out. But you can see this chart. This is a nice trade. You've got the trend environment. You've come off that trend. It's been trending now for 1.5 days, almost 2 days. You're in the oversold condition. Check, check, check. Now you get your overbought on your quicker stochastic. Check. Tagged your 20 EMA. Check. Your ducks are in a row. You take it. If you get stopped out, you get stopped out. The point is, you're adding a lot of confidence. This gives you a lot of confidence to pull the trigger, and you might get on the end of a decent move. Anyway, guys, that's the trade. Let me know your thoughts in the comment section below. It's something to look at. Consider maybe have a look at your markets that you like to trade, see how it fits in with current trading conditions that you're watching this video now, and see whether there's opportunity to make some money from it for your specific trading plan. Whatever you do, keep yours managed. See you in the next one. Take care. Goodbye.